Hi and welcome to this video. Today I'm going to be speaking about something that seems fairly odd, which is if weather does or doesn't affect the financial markets. And the reason I'm making this video is because this was brought to my attention when I was reading the book Economics by David Orrell. And in this book he spoke about how crashes happen during October. So there were quite a few examples where the financial markets crashed during October and the darker months of the year. So I thought I'd look into this a little bit more and see whether or not weather truly does affect the financial markets or if it's all just a coincidence. So if we look at it, weather can affect the financial markets directly and indirectly. And when we're talking about the weather, I don't just mean big storms or natural disasters. Even the transition from summer to autumn can cause chaos within the markets. So if we look at it in a basic sense, the season changes will cause a shift in our consuming changes. So as we change from summer to autumn or the start of school, we'll buy more tech supplies, more back to school stationery, clothing. We might buy more hot chocolate rather than iced lattes. And these spending habits will directly affect the retail stock, which then changes the stock prices and reflects in the stock market, which can cause people to either lose or gain money. It doesn't have a massive effect on the stock market, but it is a little shift that will cause a loss or gain of money. If we also look at how the seasons affect the agricultural side of things, autumn is generally the time for harvest, so a lot of strong harvests can cause an increase in supply, which would lower prices in the market, whereas if there's been a poor harvest, it might result in an increased spike in prices. This doesn't just affect crops, but can also ripple through commodities and food-related markets. When we're looking at the agricultural side as well, the natural disasters can drastically impact not only the crop yields, but the entire markets. And so this is where the idea of weather that's more violent, I suppose, or more dramatic, also has many effects, as well as just seasonal changes in the weather. Looking at the more dramatic weather, so for example, hurricane season can dramatically impact supply chains and infrastructure, and therefore building costs and manufacturing costs. And this, while they're short-term impacts, could definitely hurt a company's profits, and therefore their stock would decrease, which will therefore impact the market, and it just impacts a lot of businesses altogether. So this is the thing, because the markets are so interconnected and interlinked, for one thing to happen to one market, it'll affect the rest of the market and the rest of the economy essentially. And so this is why hurricane season, or even a seasonal change, will not only impact one thing, but it'll impact many things. So then now is when it starts to get interesting, because studies have shown that weather does affect our mood, and it will in turn affect investors' behavior. On sunny days, it has been shown that investors are more confident, they'll put more money into the stocks, buy more shares, and with possibly riskier shares as well. Whereas on cloudy days or overcast days, and when we get more into winter, there's definitely a lot more insecurity in the stocks and shares that are being bought, and a lot more doubt in where the money is going. And this can also cause people to take out money, sell their shares just to be safe and to be cautious, because the weather has changed, and so their mood is a little bit less outgoing and happy and confident. So yes, these effects are actually subtle. You don't really see massive crashes every time September hits. But there is a thing known as the September effect, and that is where stocks have historically known to get weaker during September because of the shift from summer into autumn. This also emphasizes the fact that people are not rational investors. So if you want to learn more about rationality, then you can watch more videos on that. Basically, all of the book Economics is about this idea that in economics, we base a lot of assumptions off of this economic man, where humans are actually not at all this. They are affected by emotions, by the weather, by others around them, and much more. So that's what basically economics spoke about. Along with this, investors do also reshuffle their portfolio on a more logical side of things, I suppose. When we shift from summer to autumn, they might sell stocks and shares in businesses that have more summery things and may invest into businesses that people will use more in the autumn. And this is a more logical way to think about it, but there is definitely also a psychological aspect to all of it. So then if we look at some examples, the stock market crash of 1929 Black Monday, the bank panic of 1907, those happened in October and kind of leading on from September. So it just shows how the dark months and how the start of the darker months are definitely a time that people get really nervous about their stocks and their shares and their money, and for this reason they take it out and they just become a lot more scared of losing it than they would have in the summer. And this is just a really cool psychological thing to look at. It is also emphasizing the fact that humans cannot be looked at as rational beings and that we are affected by all sorts of things, including the weather. So with that being said, that brings us to the end of this video, and whether or not you think the weather affects the stock market, I found it quite interesting to look at how it psychologically affects humans and therefore could impact the financial markets.